The most important secret of success in ICT price action strategy is to know what reaction to have at that moment. This video is going to help you a lot. Equilibrium price is a conceptual concept in economics that refers to the points in the market that are supplied for a good or service. This is the point of economic comparisons in the market and usually corresponds to a specific price. In this, the consumption of point purchase orders is equal to the number of orders from sellers. Price action is determined by factors such as changes in bid and offer, price changes, positive and negative news releases, and changes in market conditions. This price can be used as a reference point to determine the price in the market and act as a decision for the initiates and sellers. Thank you for liking the video. Let's go to the most important strategy from which you can learn a lot. The concept of a more expensive price, premium price. The more expensive price range is above the consensus price and is usually formed during a bearish wave. If the price is in a downtrend and takes a short break in an open phase to resume its downtrend, but the uptrend open phase lasts until the price recovers more than 50% of its previous decline, the price enters the premium zone. The price becomes more expensive. For example, if there is a downward wave from the price of $2 to 1 and at the price of 150, the price starts to correct upwards, and above the price of 1.75, the price is in a more expensive rank, liquidity pool. The liquidity pool in the world of ICT price action is called upper resistance and lower support levels. The reason for naming these areas as liquidity pool is the existence of a high limit of sell orders that are waiting for the price to hit the resistance level and the price to fall, or the lower limit of loss of buy orders that are set on the support zone and intend to buy the asset to take advantage of its positive volatility. The important point regarding liquidity pools is the awareness of their existence by big traders and influential people in the market. They use every way to trap other people in these areas to secure a part of their profits by activating their minimum orders. A fair value gap, FVG, in ICT style, refers to a significant price pattern in trades that indicates market imbalances caused by rapid price movements. This concept highlights the gaps between the current price and the fair value of the asset, which represents the equilibrium price based on various factors. Traders often focus on these gaps to identify trading opportunities and potential price movements. Strategies based on fair price gap trading include the analysis of these gaps to make informed decisions in the market. See, the gap can be of two types, one in the block order range and the correct block order, and one has changed its nature from suffering to rising, from rising to falling, or from falling to rising. The most important rule of this stack is to look for a price gap that can hit its previous trend or change its nature. This will cause the accumulation of liquidity, and it creates a liquidity pool that you can make a lot of profit using. Consolidation range. In the range, by aggregating market makers' buy and sell orders with almost equal volume between two specific levels, the price fluctuates in that range, and the ability to break the ceiling of the range, which is a type of static resistance, upwards. Or the bottom of the range, which is a kind of static support, does not break downwards. Finally, if the volume of orders for the floor or ceiling of the accumulation range ends earlier, the price will leave the suffering mode from the same side. A consolidation range may be formed at the end of a downtrend or uptrend, and the price will rest in this range for a while to prepare for the next uptrend or downtrend. Reaccumulation range after the growth of the price by leaving the range of consolidation or suffering in the downward or upward direction, the price rests a little during the fall or rees in the middle and then continues the same trend as before. In a way, by temporarily stopping the price in the open range, a small range is created in the middle of the uptrend or downtrend, which provides the opportunity to enter buying or selling for traders who did not succeed by buying the asset at a lower price or selling the asset at a higher price. According to the logic of ICT price action, in the correction limit between the upward trend, the opportunity is provided for the entry of new buyers, and in the correction limit, retracement, between the downward trend, the opportunity is provided for the entry of new sellers to the market.